Most investors don't buy when it's cheap. They buy when it's already too late. And the paradox is, they genuinely believe that they are acting rationally. But here is the question. What if the problem isn't the market, but the way people think? In this video, I'll break down why most investors lose money while being convinced they're making logical decisions. We will go through real examples, from Expo 2020 to the casino hype in Ras Al Khaimah, and patterns that repeat over and over again. And stay until the end, because we will get to one of the biggest traps in the market: guaranteed returns, and why it is often where people lose the most. Let's go. People believe they make decisions based on data, but in reality, we see that emotions dominate over logic, herd instinct over analysis, and fear of missing out over common sense. And this leads to a key idea. The market is not driven by numbers, it's driven by human behavior. Now think about this. If everyone had access to the same data, why do most people still lose money? Because timing is not about information, it's about psychology. And this is where things start to break. If you look at where people actually buy, it's almost always the wrong moment. At the beginning of cycle, fear, so no one buys. In the middle, growth but hesitation. And at the peak, confidence, headlines, euphoria. And that's where mass buying happens. And then the drop, panic and mass selling. Does this sound familiar? Because what we realtors see, it repeats in every cycle. Smart money buys in fear, while retail buys in euphoria. And this leads to an uncomfortable truth. People don't buy when it's cheap. They buy when it feels comfortable. Now let's make this real. Take Expo 2020, that actually happened in 2021 in Dubai. Before Expo, there was a massive hype. Marketing everywhere, millions of visitors to come, prices growth, opportunities, short-term rentals. And here is the key moment most people miss. Expectations peak before reality. So what did investors do? They entered at the peak of those expectations. They bought at inflated prices, most often off plan, expecting quick upside. And what happened after? I'm not even talking about COVID 2020 that interrupted everything. In 2021, the event ended and the market cooled. Not because something went wrong, but because everything was already priced in. And that's the rule. By the time an event happens, it's already priced in. We've seen this before many times. Olympics, World Cups, Expos in other countries. And almost every time, there was no immediate long-term growth after the event. So why do people keep doing this? Because of psychology. FOMO, fear of missing out. Everybody's buying, so I should too. Then social proof. If everyone is investing, it must be right. Then comes delayed reaction. People see growth and assume it will continue. And of course, illusion of control. I will exit in time. Ah yes, marketing. Last units, prices rising every week. And this leads to the most dangerous moment in any market. Listen carefully. The most dangerous time to invest is when everyone believes there is no risk. Because at that point, prices are already high and upside is limited, while downside is at its maximum. Now compare it to what professional investors do. They don't follow comfort. They follow imbalance. They buy when sentiment is weak, when news is negative, when demand is low. And they sell when there is hype, when people are lining up to buy, when everyone is suddenly an investor. In simple terms, professional investors buy from those who are afraid and sell to those who are confident. Now let's apply this to what's happening right now. Everyone is talking about casino in Ras Al Khaimah. Many investors see this as a next gold rush. But let's pause for a second. Is this really an investment or just a bet? Here is the core mistake. People confuse an asset with an event. A casino is not a fundamental asset. It is a bet on a scenario. You're not buying housing, which always has demand. You're not buying an office with clear economic function. You are buying assumptions. Tourist flow, regulations, political stability, consumer behavior, and none of this is under your control. So let me say this clearly. In this scenario, you're not investing in real estate, you are investing in human behavior you do not control. And this brings us to the most underestimated risk: tourism. Casinos are fully dependent on tourism, and tourism is one of the most volatile sectors. We saw it in 2020, we are seeing it now in 2026 again. So ask yourself, can you predict geopolitics, visa policies, economic shocks, regional competition? Because all of that directly impacts your investment. And the rule is simple. if the tourist flow stops, your asset stops working. Now, another illusion. It will become the next Las Vegas. Sounds convincing, but it ignores context. Las Vegas took decades to build. It has a gambling culture. And the most important, massive domestic market. This region is different. Different culture, different restrictions, different behavior, different market structure. And this is critical. Copying the model doesn't mean replicating the outcome. So what is this really? It's not a traditional investment. It's a high-risk, speculative play. I bet that everything will go exactly as planned. So why do people still go in? Because of the same psychology. Fast money thinking, I need to get it now. Success stories. It is like early Dubai or Vegas. Fear of missing out. I'll miss the opportunity. Oh yes, marketing of course. First project, unique opportunity, limited supply. And here is the trap. The more something looks like a unique opportunity, the more likely the risk is already priced in. The casino market might take off, but that's not the real question. The real question is, are you investing or are you placing a bet? Now let's go one level deeper. Another illusion investors fall into. A new massive master plan means guaranteed growth. The logic looks simple. Big project announced, prices will go up. But reality again works differently. Supply comes later and puts pressure on resale prices, and execution takes years. So again, renders sell the dream, but the market later sells the reality. And now one of the biggest traps. All investors' favorite, guaranteed returns. You've seen this. 8 to 10% guaranteed ROI, fixed returns. Sounds safe, doesn't it? Sounds predictable and risk-free. But here is the uncomfortable truth. If the return is guaranteed, you've already paid for it. Let's break it down. For example, real market price is 1 million. You're buying at 1.2 million. That extra 200,000 is your guaranteed return. You're not earning. You're slowly getting your own overpayment back. And then the guarantee period ends. 2, 3 or 5 years pass and the real market begins and the reality hits. Returns drop. Not 8 to 10% anymore, but 4, maybe 5, sometimes lower. And then comes the real problem, liquidity. You think, fine, I'll just exit, but you can't because you bought above market and then ex-buyer knows it. So he won't pay your price. And you're left with lower returns and no clean exit. And this is exactly where many investors are today. For the past few years, we've seen a wave of new buyers, recent price growth, and a belief in endless upside. So let me ask you this, are you buying because it's cheap or because everyone else already has? The market doesn't punish mistakes immediately. It gives you time to feel right and then takes your profit. Were your investments actually successful? And if you need help evaluating your assets, selling it, or finding a property below the market price, my contacts are in the description under this video. Thank you for watching and see you in the next one.